Good afternoon, everyone. My name is Darren Johnson, Senior Investment Consultant at St James's Place, and I am delighted today to welcome you all to our latest Fund Manager event, this time with Nick Purves and Ian Lance of Red Wheel, who are the managers of our Equity Income Fund. For many years, this has been one of our most popular funds amongst investors, and in terms of timings, I can imagine that the questions posed from the audience today will range from the fund itself to events going on around the world. Our aim will be to simplify where we can, making sense of the investing side of things. You will understand we're here to talk about economic and market issues. So while we will be focusing on that area within this interview, we are certainly not downplaying the humanitarian side of recent events that you will all be seeing on the news for the last month or so. This will be the usual format for those who dialed into previous events we have held, and I'll be trying to make this as interactive and as varied as possible. We have a lot of questions submitted before the event by investors, which I've tried to group into key themes on your behalf. And you can submit further questions during the event via the Q&A section at the bottom of your screen. These sessions always work best when they're tailored towards what you want to be discussed. So please, if there's anything on your mind, pop that over to me and I will ask that for you. It's worth mentioning that due to regulatory reasons, we're unable to make predictions, give advice, etc., or answer anything specific to your personal situation. So where those kind of questions are submitted, these will be given to your St James's Place partners to come back to you on. So let's get into this. Nick, Ian, again, welcome. Thank you for joining us this afternoon. While we give people time to put their further questions in, can you give us a brief introduction to your fund and the way that you manage money, please?
Yes, I'll do that. So myself and Nick have both been running money for about 30 years. We've been working together since 2007, formerly at Schroders and for the last 12 years at Red Wheel. And we've been running the SJP Equity Income Fund for just over 20 years. Our style of investing is what's known as value investing. So what does that mean? Well, philosophically, we basically believe that market participants have a tendency to overreact to short-term news flow. And what that means is that when things are good, and that could be economic news or it could be news about an industry, they will overreact on the upside. So they will end up paying too much for stocks in that sort of environment. But then they also do it on the downside. So when things are bad, investors will have a tendency to overreact. And of course, lots of examples of that in history. You know, one only need go back actually to the start of lockdown when investors, you know, really did overreact and sold stocks off very aggressively. So what Nick and I try and do is extend our time frame. So we're not too concerned about short-term news flow because we really don't think that has much of an impact on the valuation of the businesses that we're buying. What we do is try to look out 5 years or so and ask ourselves, where do we think the earnings of that business can get back to? And by implication, what is therefore is the value of that business? And where we see that the market has overreacted and it's driven the share price significantly below what we refer to as the intrinsic value, that will make a good opportunity to purchase that stock for the funds that we invest in. And so what it means is, I suppose, two things. Number one, we are pretty long term, so the turnover on the fund is pretty low. And number two, we will tend to be quite contrarian. So investors will often look at the names of the stocks that we own in horror because they will, you know, by definition almost be, you know, they will be today's out of favor stocks. The point to remember is that would have been the case at pretty much any time in the last 20 years. And yet, you know, the long-term results have been very good because what we're trying to do is exploit that overreaction. I think I'll pause there, Dan.
No, that's a useful overview and an introduction to what you do. Look, I think it's impossible to start anywhere else but the ongoing news and the ongoing conflict that we're all seeing from Ukraine at the moment. So I guess, you know, slightly vague question, if you will. I mean, what's been the market impact and indeed the fund impact to you and your investors of the Russia-Ukraine situation to date?
There's always uncertainty in economies. There's always uncertainty in markets. I mean, that's just the truth of it. I think what you can say is that when you get an event such as Ukraine, or going back 2 years, the emergence of COVID, the level of uncertainty increases as the range of potential outcomes increases. And I think, we're all desperately trying to work out, aren't we? So what is, we're obviously seeing the inflationary forces were there already, even pre-Ukraine, but they've been given extra impetus by what we're seeing today. And I think we're all grappling with, what does that mean in terms of the outlook for the economy? And I'm afraid the sad answer is that none of us really know. None of us really know. And you would have seen, you probably saw yesterday in the OBR, didn't they? They downgraded their estimate of economic growth for the UK, I think from down from around 6% for the current year down to around 3%. Problem is there is just an enormous margin of error here. It may be that what we're seeing today pushes a number of the developed economies into recession. We may see that, and that could well present problems for stock markets. So unsatisfyingly, we can't really give definitive answers as to the likely impact of what we're seeing in Ukraine at the moment. I suppose what we can do is I suppose really comes back to what Ian was saying just now, is we just continually remind people of the importance of thinking long term, and when you're trying to value companies, use long-term assumptions as to what that particular company should be capable of generating in profit terms in a more normal economic environment. And so we actually, volatility created by situations such as Ukraine is uncomfortable, of course it is, but actually we try to actually in a way embrace it and take advantage of the opportunities that it can create, and we have been successful in doing that in the past.
So this question that came in before, I think I know the answer to it, but I'd like to hear your view on this. It simply says, how likely is a market recovery from this? And we talk about the long term all the time, but yeah, how would you answer that? How likely is a market recovery from this?
It's very hard, because actually, as we sit here today, I mean, we're obviously looking at things through the lens of the FTSE. The UK market. The UK market is basically flat year to date. I think it's up a little bit actually. And so there's no recovery required at this stage, but of course that can change very quickly. So I think just we would encourage all clients just to almost just try and set themselves a long-term framework. If you go back over 100 years of stock market history, which in course has included, 2 world wars, stock markets have given you high single-digit nominal returns per annum, so around 8-9%, that sort of number. In real terms, it's probably been 4 or 5% per annum. But of course, you do get a lot of volatility around that, and so it's very difficult when the headlines are so awful, which they are. It's very difficult to try and look through that, but it's so important. It's so important if you're going to successfully harness that excess return that comes from investing in stocks over the long term.
Darren, if I could maybe just add a couple of points to that. The first one is almost a question, actually. The question being which market, because not all markets are valued the same as each other at the moment. So the American market, by historical standards, is very, very expensive. I mean, probably more expensive than it was in 2000 or even 1929. The UK market is actually very cheap by historical standards today. So I think that the UK market actually, from that point of view, is a pretty good place to be. And then the second point that I would make is that, of course, you have appointed us to be active investors, we don't buy the market. We're trying to buy the cheaper stocks within the market. And at points in which you get these big events being things like, the financial crisis, COVID and lockdown, and indeed, what we've seen in the last few weeks, what you tend to get is a sort of bifurcation of stocks within the market. So what investors who are very focused on the short term will do is there'll be a flight to what you might call quality or defensive stocks. And what that does is it pushes the valuations of those up. And then the other side, you will get a flight out of more cyclical stocks, pushing their valuations down. And that provides an opportunity to us. So I think it's just worth adding those.
Yeah, I think everyone wants their fund managers to buy low and sell high, but it isn't comfortable to get to the low to buy.
Indeed.
So, look, Nick, you mentioned inflation there, and I think that inflation. Everyone's seen inflation around for a long time. One fund manager said to me in the summer of last year that inflation was everywhere apart from the official data at that point. Everyone has seen this and been dealing with it in their own way for the last year or so. But of course, the numbers are quite eye-catching now. The press report it as they do. So I think it's worth exploring. And obviously, the Russia situation is not going to help that in any way as it prolongs. With inflation rising across the Western world, then, and we're told expected to peak in the UK at around 8% later this year. What effect does inflation tend to have on equities historically?
Yeah.
Again, because Nick and I are not sort of top-down macro guys, what we will tend to do is maybe look at periods in history for a guide on what it might mean. And of course, actually a lot of us haven't really witnessed a period of sustained inflation in our investing lifestyles because the last time really was the 1970s. And so actually it's quite interesting to go back to the 1970s and ask yourself, what happened back then? And does that give us any guide for what might happen now? And just a couple of interesting observations. Number one is that our style of investing, i.e. value investing, actually did very well in the 1970s. So across the 70s, equities did okay. In other words, they kept up with inflation by the end of the decade, albeit that you did have quite a nasty drawdown in 1974. But actually value did a lot better than the wider market. And there were two reasons for that. The first is that value was very cheap back then, and it's for similar reasons actually. Whereas today, people have become pretty obsessed with, I suppose, the growth area of the market. The FANG stocks, if you might want to call them that. Well, back then there was a similar thing going on, but back then, funnily enough, they were known as the Nifty 50 companies. They were the sort of growth stocks of their day, and a similar thing had happened. Those stocks have become very expensive, and value stocks have become very cheap. So that was the first point. The second point is, I suppose you've got to remind yourself about the makeup of that value area of the market. It was things like the energy sector, mining companies. It was companies where profits went up as inflation went up, and actually, therefore, the profits of those companies also did well. So you had both cheap and growing profits. And again, we would say that there are some similarities with today because we think those areas of the market quite cheap, and actually, their profits at the moment look to be faring pretty well. So that I suppose that's our answer really to the inflation question. We don't 100% know where it's going, but if you look at history, we do feel like it is potentially good news for our style of investing.
Yeah, I think you might have inadvertently answered a question that's just that minute come in about our dividend stocks historically a decent inflation hedge. Is that, would you agree with that, or?
Yes, I mean, I think one needs to disaggregate the short term and the long term. I mean, if inflation, obviously inflation is very elevated at the moment, largely because of base effects. Because obviously you've got to go back to where we were last year, and I think this time last year we were still in lockdown, weren't we? if inflation gets totally out of control, I mean, that is a bad place to be. That is a bad place to be, because what it basically, the credibility of the central bank starts to call into question. And the markets will, the bond markets and the equity markets will ask the central banks the question: are you prepared to raise interest rates to where they need to go in order to bring inflation back under control? And that can be a pretty uncomfortable period for equity investors. But assuming that, you know, inflation remains relatively moderate, and you know, and the central banks retain their credibility, and interest rates don't have to move too high. And you know, I suppose if you just go to the bond markets today to form a view of, you know, where is the bond market saying that interest rates are going to go to in the coming years, then that sort of level of inflation and that sort of level of interest rates should, in that environment, equity should give you some decent real returns and thereby protection from inflation.
And you know, it's worth remembering in the very long run. I think, you know, I've seen papers that have basically pointed out that dividend yield produces a greater return than inflation growth and re-rating added together. There's a very famous paper called Dividends and the Three Dwarfs that pointed to the long run history of that. The only other point I would add on dividends is they've been quite out of favour for the last few years because everyone sort of got used to the stock market going up 20% per annum, and when the stock market does that, of course, who needs dividend income? You could just sort of sell a bit of your capital and use that to fund, turn that into income. Well, you know, maybe if we're in a new environment in which actually we can't rely on stock markets going up at that sort of degree every year, you know, maybe dividend income does become important to people again, and in that environment, you know, hopefully that's favourable for us.
I mean, that's useful to explore what next. I think we've done a reasonable job of summarising where we are and where we've been for the last few months. In terms of what next, I mean, what you just said there, I'd like to tap into that a bit further. Of, you know, do you think we might now be entering that environment where dividends become important to people again? Because traditionally in the UK, we like that style of investing. That's part of what we do as UK shareholders. We like dividends. That isn't necessarily replicated around the world, but in the UK it is. And of course, that's where you're investing. But total return is important to people. And I speak to a lot of investors and they almost don't care where their return comes from. Yeah. It's just return. Do you think we're now entering that environment where dividends are, I appreciate 2 years ago, dividends became unreliable for reasons that everyone is aware of, but you know, are we entering a period where they bounce back a reasonable amount and
well, we think the stage is set for that, certainly. I mean, the dividend investing has experienced its perfect storm, if that's the way you want to think about it. As you observed, you know, many companies, particularly in the UK, cut their dividends or abolished their dividends in the spring of 2020 in response to coronavirus. I think I'm right in saying the top 350 companies in the UK, 40% by number, cut or cancel their dividends. And I think to a whole generation of investors who have really come to rely on not only dividend income but growth in dividend income over time, that was a very nasty shock. And of course, this took place, didn't it, at a time when, barring the immediate sell-off in the face of coronavirus, actually equity markets generally recovered very strongly, didn't they, from the enormous amount of fiscal and monetary stimulus that we saw as a result in response to COVID. And the areas that did particularly well were US equities and what we call growth equities, and particularly technology stocks. And so you had one group of stocks producing fantastic capital returns, and you know, coming off the back of a number of years of strong capital returns, producing fantastic capital returns at a time when another group of stocks, the income producing stocks, were disappointing by by cutting back on their dividends. And I think there's we think there's a danger there that it's taught perhaps a false lesson, which is that in say investors, as you said, investors perhaps don't need to worry about where their return comes from. You can literally just book your return from the capital account because capital returns are strong. Turn it into income. It's more tax effective anyway, isn't it? Because capital returns are taxed at a lower rate than income returns. And that's just the easy answer. But the challenge there is that ignores 100 years of stock market history, which, as Ian said, suggests that, in a normal environment where stock markets are giving you normal levels of return, you need to rely on the income account. So we would say we would be very wary of relying on that for your relying on capital appreciation as a source of dependable return.
You mentioned there as well, overlapping onto another area I wanted to get into. The investment landscape feels different in the last 6 months to the last 5 years. Best performing areas lately: energy, mining, financials, and obviously those technology stocks that we all know in the US, etc., that should have driven everything, including a rise in passive investment. They've experienced a pretty large drawdown for anyone who's seen the NASDAQ in the US over the last 6 months. What do you think the catalyst was for this in November? That seems to be when the market peaked and started creeping downwards. And do you think that's an evolution, or do you think this is a short-term problem for that particular sector?
Stock markets are just fascinating beasts, because you can even look back after a particular event or a turning point in the stock market. That's the way you want to think about it. And even after the event, people can't agree what it was that caused the change in direction of the market. So when you'll remember that in the late 90s, in 2000, technology stocks got to very high valuations, didn't they? And then in the spring of 2000, I think it was March the 8th, 2000, they just started to fall quite sharply. And even after the event, no one can really work out what it was. Why is it that day something changed? It's just the valuations in that area have probably just got to a level where they run out of the sellers started to outnumber the buyers. And then once things start to move, they can generate their own momentum. In March 2009, after the financial crisis, so this is 6 months after Lehman, the market just started to go up, despite the fact that the economy was in a complete funk at the time. If you looked at the economic indicators, they would not be telling you to buy the market in March 2009, and yet the market started to move up very aggressively. And I think the message here is that it's really, really important, we think, to take your signal from valuation, because although valuation has very little predictive power on return in the short term, it has a very, very strong inverse correlation with return in the long term. So if you buy when assets are cheap, you get strong returns. When you buy when assets are expensive, you get weak returns. And it's so commonsensical, and it's the same in every other aspect of our lives. That holds true, and so it has to hold true in the stock market as well. And I think so. It's a long-winded answer, and I'm not even sure I've answered your question. What caused technology stocks to change direction, whenever it was in November? They just become too highly priced. Is probably the answer.
I suppose, Darren, if I had to, hazard a guess at all, the conditions for the last 5, maybe even 10 years have just been absolutely perfect for growth stocks. Those conditions being low inflation, low interest rates, quantitative easing. And then during last year, we started to see inflation pick up, didn't we? And there was a debate raging for a while as to, some were saying it was transitory, some were saying it, no, it wasn't. And as we got towards the end of last year, I think actually even Jay Powell, the chairman of the Federal Reserve, was forced to admit, no, it's not transitory. And therefore, the market actually began to look forward and think, well, maybe therefore interest rates are going to have to go up. And maybe those conditions, which have been so perfect for growth stocks for the last sort of decade, were beginning to reverse. And what was really interesting was, although, for instance, I think the US finished last year up 20%, NASDAQ up 20%. Actually, if you looked in detail, even by Christmas, 40% by number of the NASDAQ composite stocks had halved in value. So the market was beginning to sort of rotate out of those companies into value companies. And as Nick says, the other thing was just that the valuations had just become so stretched. One example that we use is if you look at the software sector in the United States, the valuation of that had gotten to nearly double the valuation that it reached in 2000. And by the way, from that point in 2000, it lost 80% of its value. And yet last year it was nearly double that. So those companies had just become phenomenally expensive. And on the other side of the boat, a lot of the value stocks were very, very cheap, and therefore it really didn't take much.
I think investors are realizing now the sheer scale of some of these tech companies as well, in terms of their impact on market values. I mean, some of these companies are bigger than countries. That's how much they move things. So when Facebook fell 26% in one day, that's the equivalent of a Netflix going out of business.
That's right. And I think the other statistic was, I think something like 80% of the S&P 500's returns in the last 6 months of last year were driven by 6 stocks.
Yes.
It was just the big tech companies were continuing to go up, whilst a lot of the market was actually starting to go down. But they're so big that they drive the indices.
Yeah. So let's move back to the UK. Let's dig into a bit to your fund and some of the companies you hold. We had a question up front that I think actually, asking about particular companies will give even more of an insight into how you manage money and how you think, etc. So Royal Mail was the first one I received. So it was, were you tempted to sell Royal Mail recently after the large increase in share price? So how are your thoughts on Royal Mail at the moment, which I think is the 3rd largest holding in your fund?
Yeah. So and again, that's a good example of a company that's been volatile. I mean, obviously it fell very sharply at the start of COVID. I think the market's initial reaction was that COVID was probably going to be bad for Royal Mail. Actually, quite quickly, even by the probably the autumn of 2020, the market was starting to figure out that actually COVID was probably quite good news for Royal Mail, because obviously we were forced to be at home. The amount of shopping online was growing already, but it increased very dramatically, and of course, therefore, that gave a significant boost to Royal Mail's parcels business. We don't buy everything well, I can assure you, but that was one we did buy pretty well. And you're right, the shares did go up very significantly. I mean, we bought the shares around £2 a share. The share price actually peaked at around £6 a share, so they tripled in relatively short order. So did the channel, but we didn't sell at £6. We sold some to manage the risk. The position size became quite big, so we did sell some down, but we didn't sell out of the position size. One of the big challenges with COVID, the volatility was so great. A lot of share prices have moved around so significantly that it creates quite a few confusing picture. People kind of trying to maintain a sense of relative value when share prices are moving around so fast is quite a challenge. And again, we always take our cue from valuation. And the reason that we didn't sell the whole lot at £6 was because we still actually, believe it or not, believe that despite the fact it was tripled, it was still undervalued. And let me try and justify that statement. When it bottomed closer to £1. At £1, the company is valued at about £1 billion. And in the year to March 21, so the year that finished about a year ago, the company delivered 700 million of profit. So at the low, in the height of the coronavirus panic in the spring of 2020, the business is being valued at around 1.5 times its annual profit. I mean, that's just extraordinary. I mean, so you can see when you put it in the context of those sorts of numbers, you can see that actually when you get to £6 and the company it's on around 7-8 times its profit. So still very good. It's still good value on a long-term perspective. It's just not the extreme level of value that we saw when it was sitting at £2 or even lower than that.
You also predicted when we talked before this that there would be a question about Marks and Spencers, and you'll be glad to know that there has been. It seems to be a name that fascinates the UK investor, a recognisable name. So that's obviously also in your top 10 holdings. So what are your current views there as well?
This is really back to Ian's point, Ian's sort of description of our investment process or the way we think about things at the beginning. One of the things we're really looking for is companies that perhaps they've struggled for some time, either because they've been poorly managed or because their industry is going through some significant change. And where things have started to improve, but where the market is not giving the company any credit for that improvement. And we absolutely think that Marks and Spencer falls into that class. And we understand totally why people are skeptical of Marks and Spencer. The company has been, I mean, not the current management team, but for a long time was managed very poorly in an industry where there is significant change. And we as consumers, our buying habits are changing enormously. And those trends were only accelerated as a result of COVID. So you had a changing industry and a company that was being poorly managed. And therefore the operational performance of Marks and Spencer was very poor for a long period of time. That really started to change, we think, in probably three to 4 years ago with the arrival of a new chairman, a chap called Archie Norman. Some of your clients may be aware of him. He was the man who turned around Asda in the 90s. He's got an impeccable pedigree. He's done a great job at a number of companies. And he started to make, him and the management team started to put through some very, very significant and profound changes to the company. You might be aware that they up until 3 years ago, they had no exposure to online food. They now have 50% of the Ocado joint venture, which is performing extremely well. They are already turning around the in-store based food business, and believe it or not, Marks and Spencer food in store is taking share of pretty much everyone else off the high street at the moment. And of course, food retail is quite a good place to be during COVID, because at the end of the day, we all need to eat. I think when people think about Marks, we tend to just think about in-store clothing sales and a tired brand losing market share. Again, that's only 1/3 of the company's sales are actually in clothing now, and half of that is actually in online clothing, where after a very slow start, the company is now doing really well. It's taking again significant share. It means that less than 20% of the company's revenues now come from in-store sales, which is what we all associate Marks and Spencer with. So despite the fact you're seeing all these positive changes, the market is still being very, very mean when it comes to the company's valuation. Again, the company's got a March year end. is estimated to produce over 20p of earnings per share in the current year. Share price today is around £1.60. So it's trading on around 8 times earnings, which is, again, a very attractive valuation. You probably, again, your clients are probably aware that private equity have been very active in the UK. And we don't think there's any in the last 12 to 24 months. And we don't think there's any coincidence. It's because the UK is a friendly place to invest. And it's because, as Ian said earlier, UK valuations are very attractive. You remember that Morrison's was taken over at a very significant multiple. Well, we think that Marks and Spencer's food business is better than Morrison's. We think that private equity could well be attracted to Marks and Spencer, and they buy anywhere near the current share price when they wouldn't be allowed to because they'd have to pay a significant premium. They would make a very attractive return. So, again, a slightly long-winded answer, but it is, again, in some respects, just the sort of business that we are actually looking for.
And I'm conscious of how many questions are coming in, so I'm probably going to go a bit quick fire from now on. Finally, on the top 10 holdings, this one, what's been the impact on your oil stocks over the last month or so? And somebody's also asked about the ESG side of that, which I think is useful to reiterate if we could combine that. You know, what's happened to oil stocks in the last month, and how do you see the ESG side of BP and Shell?
I mean, the last month they've been volatile, actually, because the oil price has been quite volatile, and then obviously the news from Russia has been mixed for them. And when I say mixed, some of them had some Russian holdings, like BP had a stake in Rosneft, and obviously that's bad. But then that's been countered by the fact that the oil price has gone up so much. If you look at them over the last year, the energy stocks have been, as I said earlier on, basically the best performing sector in the last year. So the energy stocks have been very good for us. And funnily enough, actually, just like Nick was saying earlier on with Royal Mail and Marks and Spencer's, we still think they're very cheap today because of that geared impact on the oil price. As the oil price goes up, it feeds through to the bottom line, and they just begin to throw off cash and pay out dividends. So hopefully that answers that. On the ESG side, our mantra has always been basically engage rather than disinvest. We've never believed that there's any sense at all in just selling the holdings off the portfolio because literally all that happens is they change hands. That doesn't change the behaviour of the companies one iota. What changes the behaviour of the companies is their shareholders engaging with them and pressurising them to improve their environmental performance. So that has always been our mantra, and we think that's much more effective.
Can I just add a couple of points there, because I'm sure your clients are, some of them quite concerned perhaps, both about the ESG angle and also obviously what's going on in Ukraine at the moment. Let me just be absolutely clear. BP is in the process of writing down its investment in Rosneft. It's had a 20% stake in Rosneft to zero. BP had members on the board of Rosneft. They've all come off. They are disposing of that business. BP is coming out of Russia totally. Shell does not having its investments in Russia have been through, I think it's 3 individual projects. Again, Shell is coming out of those projects in Russia and will take around a $3 billion write down as a result. So these companies are basically coming out of Russia completely. So that's point number one. Point number two is on the ESG. One of the things we look for when engaging with the companies is to make sure that each of the companies has credible ambitions to get to net zero carbon emissions by 2050, which is where collectively we've agreed we need to get to if we're going to have a chance of meeting the stipulations of the Paris Climate Change Accord, which is that basically we should limit global warming to 1.5 to 2 degrees centigrade. And, it would be clear, it's going to be a difficult transition, of course it is. And there will be, bumps along the road, of course there will. But, they are serious. They are serious, these companies, and they are investing enormous amounts of money in making that transition, funded by obviously the cash flows that they are receiving from selling oil and gas. But we really do hold these companies to account, and we believe that they really do want to try to get to where we all need to get to as a society. So we really do think that investors, you can invest in these companies with a clear conscience, both from Ukraine perspective, but also from the longer term issue, which is obviously an ESG perspective.
That's really useful. So complete tangent here, because the word, I know you're not macro guys, but the word stagflation has come up on 3 separate occasions, so I've got to ask that all at once. What are the risks of stagflation, and also what are the consequences of that on equities, and is it possible to protect against?
I suppose, or yes, absolutely, it's a risk, because, as Nick said earlier on, commodity prices going up very significantly, and that clearly is having an impact on economic growth, as the OBR told us yesterday. I suppose I would just refer people back to my earlier answer, which was stagflation was what we had in the 1970s, and yes, that was bad for equities per se. As I said, 1974, you get a 50% drawdown, but by the end of the decade, actually, because equities are a real asset, actually they've done okay. And again, just reiterating that point about the cheap part of equities actually did very well in the 1970s. So really, I suppose we can't really say a lot more than that. History, I suppose, is just our guide there.
Yeah. And again, not to get into predictions, you're probably wondering where this one's going. Would a sell-off in UK bonds be of benefit to UK equities?
Again, hard to know for sure, but as I was saying earlier on, the conditions and bond yields coming down were favourable for growth stocks, because, without trying to get too technical, growth stocks are a long duration in their nature, because you're getting the cash flows far out into the future with a lot of technology companies, and therefore interest rates coming down was good for those companies. Interest rates going back up, by reverse, is bad for those companies. Good for shorter duration companies, which are value stocks, dividend stocks, if you want to think of it that way.
Yeah.
Within reason.
Within reason. Yeah. Within reason.
If interest rates going to 10,
yeah,
then no, I don't think it is good.
Yes.
Cool. Somebody's asked a sector-wide question about travel stocks, and that could be, I guess, airlines or cruise companies. And then somebody's also asked whether you've got any exposure to P&O. So I don't know whether you want to discuss that as a sector-wide thing as well as that particular issue.
So P&O was actually taken over, but DP, when you'll hear the word DP World associated with P&O, the D in there, I think, is Dubai Ports Authority. So it was taken. P&O, as we used to be quoted, didn't it? But it was, it was taken over some time ago. So no exposure to P&O, but the wider issue is obviously very important, and that's obviously it does social issues. We talk about ESG, and I think we all perhaps don't we focus slightly unhealthily on the E part of the ESG. The S part is important, and that's something that we also focus on. What was the second half of your question?
Travel sector.
Airlines in particular, apparently.
Yeah. We have a small holding. We have a small holding in EasyJet, but actually, the exposure to the airline sector is we have very little in it. It's a brutal sector to be involved in. To be honest, it's very capital intensive, as you know. It doesn't matter whether you're running an airline or a cruise company. Very capital intensive. Very cyclical. Obviously, demand, even in normal times, is quite cyclical, but then you chuck in COVID on top and it becomes very, very cyclical. And worse than that, a lot of the companies actually went into coronavirus with their finances in relatively poor shape. And that is not a good place to be. So a lot of the companies actually had to raise fresh equity. EasyJet themselves had to raise some fresh equity. So no, we had very little exposure to that area of the market.
And of course, not helped by the oil price being $120.
Absolutely, yeah. They don't seem to get much of a break, those companies.
Certainly not. Last one, which I think is a really interesting question. I mean, you've managed money for a long time. I won't tell people how long, but it's a long time. And in particular for St James's Place for nearly 25 years. How do you think your strategy has changed over the years? And indeed, has it changed over the last couple of years in what feels like a more chaotic environment? How do you feel your strategy's evolved over that time?
I think all your clients would probably want you to hear that your fund manager is the completed article, but unfortunately that's not the case. Life is the stock market. You are to a certain extent learning lessons as you go along, and I think and that's another way of saying perhaps that experience. We do think that experience counts in stock markets, and we are long enough, both of us, in the tooth to have seen a few stock market cycles come and go. And I think one of the lessons we've certainly tried to learn over time is that we live in a totally unpredictable world. We can sit here and speculate about where interest rates and inflation might be in a year's time, but I pretty much assure you that no one saw COVID coming, and so there's always the potential that an unforeseen event is going to cause some sort of distress in the system or dislocation in the market. And we think it's really, given that uncertainty, we think it's really, really important that you're invested in companies with strong balance sheets, strong finances, who can weather the downturn to come out the other side. Because as we said right at the beginning, what we're trying to evaluate is the long-term profit potential of a company in a normal environment. Well, that means nothing if your balance sheet or your finances aren't strong enough to get you to that point. And so I think that's probably the principal lesson that we have tried to learn over the years. And I say COVID was horrible for everybody, and and obviously created an enormous amount of uncertainty and volatility in the stock markets. But it's proved to be relatively temporary as far as our investments are concerned, because they all had the strength of finances to come through to the other side without having to issue substantial amounts of fresh equity.
I think the only other thing I'd add, Darren, is as time has gone on, we've learned to just try to let things run. Actually, try to leave the portfolio alone, and that's not because we're sort of on the golf course every day. It's because historically, if you look, when some of the big trends get going, they get going for years. I always think a fabulous example is right at the top of the TMT bubble. The cheap stocks back then were things like tobacco companies and utility companies. Some people listening might remember British American Tobacco was bottomed at about £4 or £5 back then in 2000. Remember that was the top of the stock market. 10 years later, it was nearly £50. So, if you'd sold that after it had doubled or even trebled, you would have felt pretty happy with yourself. But then you would have felt quite frustrated as you watched it go on to £50. And I think that really is a lesson. Actually, is don't be too quick to take a profit. If you still think the fundamentals are going in the right direction, you still think the valuations are supported, you just leave things alone and let them run.
Courage to build convictions, eh?
Yeah.
Yep. Nick, Ian, I think we've pretty much gone over everything we could have done in the time allowed. Unfortunately, we've come to the end of the session, but I really appreciate how you've answered everything I've thrown at you. I know a live Q&A is never easy. You never know what's going to come in, etc. Thank you to everyone who took the time to dial in today. Thank you to Rebecca for putting this together again. And thank you once again, Nick, Ian, for taking time out of your day to speak to us. We really appreciate it. Everyone on the line, stay safe, stay well, and hopefully we'll see you all again at some point soon. Thank you.
Pleasure. Thank you.
Thank you.